So Tom Lee is back at it again with a very, very bullish call for 2025 and 2026, and there's going to be a lot of people that make a lot of money. Let's take a listen.
We have this rally that's now extending probably beyond what most were positioned for, but it started in a moment of peak uncertainty.
Yes.
And even when we were in peak uncertainty, a lot of us were saying that's kind of usually forward-looking bullish. But are we now getting to a point where we have finally feasted on all of the uncertainty and now we have a lot of these blanks being filled in?
I don't. I think that it is appropriate that we are making new highs because the fundamental and the visibility is better now than it was in February at the old highs. And I think there's three levers that are going to get pulled.
So before Tom talks about those three levers, he's talking about this visibility and clarity in the stock market right now, how it's better right now versus the beginning of the year. Because remember, we had Trump talking about all these tariffs, whether he was going to put them on or not put them on. And then we had Liberation Day and they were way higher than what we all thought. But now we're getting trade deals and now we're getting pauses on tariffs until we make these deals. So there's a lot more clarity right now versus then. So that's bullish for the stock market.
One we know is that Fed didn't unleash liquidity at the April lows. So we have a Fed that's been on hold and tight. But if the information and the data comes in dovish, that's 12 to 24 months of Fed liquidity and dovishness. That hasn't happened yet.
So two charts super quick to show you what Tom is talking about here, how the Fed is kind of holding out on us. And when the Fed actually starts to cut, there's going to be a lot of liquidity into the stock market. Rates are going to go down. And typically when the Fed cuts, when the economy is doing well and the labor market is okay, the stock market usually is going to rip higher. So the first chart here shows you the federal funds effective rate going all the way back to 2020. So just like a 5-year chart here. And you can see the Fed raised interest rates from pretty much nothing all the way to 5.33%. And we did do this little cut of 1% right here. We're now at 4.3, so 1% lower. But the Fed still has a lot of wiggle room between 4.3% and 0. And on top of that, if we take a look at the inflation chart, yes, we raised rates because coming out of COVID, inflation went way up. So inflation went way up, but look at how far it's coming down right now. We're very close to the Fed's 2% target. So the closer that we get to this target, the more confident that the Fed is going to be to cut these rates down closer to 0. And on top of this, the big whale in the room that not many people are really talking about is this idea that as inflation comes down, we get it that interest rates are probably going to go down with it. But Jerome Powell is being stubborn right now. And the more stubborn that Jerome Powell is to cut interest rates, Trump is getting more frustrated. So this is brewing this perfect storm because guess whose term at the Fed is up in 2026? Jerome Powell's. So Trump is promising us that he's going to appoint someone to the Fed that is going to cut interest rates. And Trump is saying he wants rates to be 1 to 2%. And right now, like we said, we're at 4.33%. So if we go from 4.3 down to 2 or even 1 on the federal funds effective rate, the stock market is going to love it as long as inflation stays in check, which I'm in the camp that inflation will stay in check. So again, a very, very bullish catalyst that's happening in the market right now. And I do feel like that's why the market is pushing higher because the market is starting to price that in of this potential that rates are going to go down. So very, very bullish if this actually plays out.
The second is that I think that there is a false argument. People are saying the multiples are stretched. The PE should be expanding because we've now had 5 stress tests that companies survived. They survived COVID, they survived the bullwhip effect, they survived the inflation surge, they survived the Fed fastest hikes, and now they survived Armageddon. If you don't have 5 more episodes, multiples will be higher 2 years from now.
So let's look at 2 charts super quick that break down what Tom is talking about with this elevated valuation level and this price earnings ratio that's a little bit high. So there's a few different indexes on here, and these lines just show you the price earnings ratio of a certain index. So the pink one is the Mag 7 and the red one is the S&P 500, which those are the 2 main ones that we're going to focus on right now. So you can see going all the way back to 2000, if we just average this out for the pink line right here, which is the Mag 7, we could say that the average price earnings ratio is somewhere around 22-ish. So when the market took a dip, the price earnings ratio went down in April. But now that the market rebounded out of that, the market is now a little bit stretched off this average line right here. And again, the S&P 500 average price earnings ratio, which is the red line here, it's typically around 17 to 18, and right now we're closer to 22. So again, this chart shows that valuations are a little bit stretched simply if you look at the price earnings ratio level, but it's not that simple because price earnings ratio is just simply dividing the price by the earnings per share. It's not factoring in growth. It's not factoring in maybe we get interest rates down to 1 or 2%, which is so bullish for the stock market. It's not factoring in tax cuts, which we just got. There's a lot of things that this does not factor in. So simply looking at the number, yes, it is a little bit expensive, but when you factor all that stuff in, it doesn't look too bad. And this chart we talk about a lot on this channel, but it just updated. So the red line is the S&P 500 and a blue line is a price earnings ratio level of the S&P 500 if it was on the blue line at that level. So I'm not going to go deep on this, but here's the key thing to understand. Look at what happened to the S&P 500 when it was trading near this upper band on a price earnings ratio level. This was, of course, in 1999. We all know that the stock market went down pretty sharp in 1999 because of valuation concerns. Tom was talking about how there was elevated valuation levels during COVID, which it was a little bit expensive, but it was not near, this is a COVID drop right here, it's not near the valuation level that we're at right now. Like COVID before the drop, it was right around 20 for the S&P, and right now we're at about 22 and a half. So we are a little bit more elevated versus that period over there. So the point that I'm getting at is this. Typically, when a valuation is a little bit stretched like 1999, the years going forward for the stock market aren't going to be so good because a lot of the future growth is already priced into the stock market. So that is a concern right now. Maybe a lot of the future AI growth is already priced in. Time is going to tell. But if we reverse this, take a look at how the stock market does when price earnings ratio levels are low. Look at what happened coming out of the 2008 financial crisis where the PE ratio was down near a level of 10. Massive returns for the next decade. And of course, there's a lot of volatility along the way, but huge returns on the stock market right here. And this was one of the most powerful bull markets that we have ever seen in the history of the S&P 500. Again, down here going into the 1999 crash. Coming out of 1990, we had a little bit of a dip right here, but we saw a price earnings ratio expansion all through this level right here, which basically took the PE ratio from a level of 10 all the way up to 25. So that is a 2.5x of the price earnings ratio expanding. And a lot of that was the cause for the returns in the stock market. It wasn't so much that the earnings were going way up, it's that the market was just simply becoming more expensive. So let's listen to Tom on number 3, and then I'll give you my full breakdown on what I think is actually going to happen in the market for 2025 and 2026. Here we go.
And the third is that I agree with anybody who says that, look, we've kind of reshaped some of the economic flows around tariffs, but that's an upside story because if it plays out better, that's an earnings surprise. So you have 3 levers that tell us that 6,200 is the market beginning to recognize we're in a better position while $7 trillion cash is on the sidelines. And I can tell you, our clients, institutional clients, remain very skeptical. This is the most hated V-shaped rally.
I grant that given the strength of the rally, investor sentiment pretty much across the board has lagged. It's not as bullish as you would normally expect. The $7 trillion in money market funds, though, I mean, to me, it's a non sequitur. It always goes up. Unless you're at the end of an awful bear market, the money doesn't come out of money market funds. And then right now, as a percentage of total market cap, the S&P is like $60 trillion, or the U.S. market is. But it's like, what are we talking about?
Well, there's a couple things to keep in mind. One, in fact, money market balances have declined. They only started to rise really in 2022.
Right, they had a stutter step and then they went up.
If you look at margin debt, NYSE margin debt, the dollar amount absolute is still below where it was in October 2021. So you have like 4 years, it's 4 years and you're still not even higher in margin debt. And third, it really doesn't take, you don't need 60 trillion to come into the stock market to have it rise 10%. You probably need 200 billion. And I think there's a lot of high net worth money. I know there's a lot of our institutional long short macro that is shorting this rally. And the long only managers are defensively positioned. They don't believe in a cyclical long. But look, if rates come down and the Fed starts easing, it's going to force people into a cyclical tilt. The job market's good. So now the waiting game is, how much will inflation surge over the summer? Inflation expectations are actually coming down. So now all that we're waiting for is let it get through this CPI hump. I do think it means that once you get into September, we should really think about cuts coming. And that's what I would focus on more as an investor, that, well, that's a cutting cycle. The Fed won't just do one cut. They're going to continue cutting. ECB and the U.S., 200 basis point different in monetary policy rates. But if you take CPI year over year ex housing, which is how Europe calculates it, we're both at 1.9% today.
So our boy Tom Lee, he is very, very bullish right now. And a lot of people, they're probably going to make a lot of money. So this is how I'm capitalizing on 2025, 2026, and beyond in the stock market. So this year and next year, I am cautiously optimistic in the market. I think we are a little bit extended fundamentally. But if interest rates go down to 1, 2, even 3%, that is so bullish for the stock market. Rates on your mortgage will go down. Rates on a car is going to go down. People are going to be borrowing money like crazy. Cost of business is cheaper. Earnings per share is going to go up. We just got tax cuts, so earnings per share is probably going to go up because of that too. There is some positive catalysts that are building in the market right now, on top of more certainty, like Tom Lee said, on top of all the bad things that the market went through, and it's still here at an all-time high standing tall. And I get it that it's always easy to focus on the bad things happening instead of the good things happening. So right now, I am extremely bullish in the stock market if we go 2-3 years plus down the road. But next year and this year, I expect a lot of volatility in the stock market. market, and my exposure to stock options right now on a leverage basis is not too high. The market ran up a lot since the April 8th low. I made a lot of money. I took a lot of profits. But again, if the market keeps ripping higher, I'm in a position to capitalize. But if it goes down, there's no chance that I could be wiped out because my assignment value for sold puts is so much lower than what my base portfolio is. And if you don't understand what that means, click link below, do my course, come into Discord. It's 100% free. It's going to blow your mind and teach you everything how I scale to millions. But if you don't want to do that, watch this video right here. It's going to break down FOMO, the emotional aspect of investing, and why most people lose money. I'll see you guys there.